Welcome everyone once again to Maverick Trading's educational series, and today we're going to look at the stock market crash in growth stocks. Growth stocks have absolutely positively crashed. We want to explore the signs of that, the frothiness that happened before that, how to take advantage of it going forward, and kind of detail a little bit of the history of that. So let's dig in by going live here a little bit to Google Finance. Now, in order to really understand what's happened in growth stocks, maybe we need to start with a little bit of the ARRK Innovation ETF. Cathie Wood is the popular growth investor, and she really made her name investing and believing in Tesla, which was her one big call. And that one big call carried her fund to some high highs, and investors just went after her for her popularity and because she had done really well during that period of time, basically leading up to 2021. She was the most popular investor, fund manager around. Billions of dollars of capital flowing into the ARRK ETFs and the ARRK management, money under management, and she was just living the high life. Now, fast forward about 1 year later, and the price is collapsing. She's given away all of her upside and then some since many years ago, and it's just been an absolute disaster. So, how do you explain her fund, this ETF, and she's got others, but them going from 160 down to 40? How do you explain 80% declines and these sorts of things? Well, what she believes and invests in is innovation. Companies that are not turning massive profits for the most part, but that are expected to change the world and to benefit from that as share prices. And so, if you go into the fundamentals of the companies that she invests in, here I'm just at Google Finance, but Teladoc would be one of her most popular bets, right? Instead of traditional medicine, you use Teladoc. You can use phone. You can use other ways to speak to a healthcare professional. All these different ideas that they have. If we scroll down through Teladoc and look at its annual numbers, this is what you're going to see quite clearly: is huge growth in their business, but not profitability. See, the red, or the green, pardon me, is revenue. This is the total amount of sales. Are they getting more customers? Are they bringing more money in? And does that lead to profitability? Well, for many growth stocks, you don't turn a profit, but you can actually see that they're losing quite a bit of money. You can gain customers by spending a lot of money, but that doesn't mean it's necessarily a good idea. Are you actually gaining market share? Will these earnings turn profitable? At what time period? And so on. And this is not specific to this one name. If you look at, just about anything in that growth complex, you're going to see that the fundamentals look very similar. The revenue's growing, but the earning and the profitability going in the opposite direction. This particular company brought in 1.3 billion and lost 1.5 billion, and on and on the list goes. They're trying to gain subscribers, trying to gain business, but they are not, for the most part, profitable businesses. So what's changed in the market? Well, one of the big changes that's taken place is inflation. When inflation runs hot, and right now it's at about 8.5%, that creates problems for growth companies specifically, because now all of a sudden you say, well, if you run all these discounted cash flow models and so on, it's basically, what can these companies gain in earnings and how long is it going to be? And it's a multi-year story. In many cases, it's a multi-decade story. And so if you're losing, if inflation's running hot and specifically interest rates are running hot, like look at the bond market, which has had one of its worst years in history thus far. These are corporate bonds, and you can see that the price is collapsing. And as bond prices go down, yields go up. So mortgages, all of these rates are climbing. The Fed has to raise rates to try to slow down price dislocations. Inflation is running super, super hot. And now all of a sudden, it makes it less interesting to invest in growth companies that are not going to turn a profit for many years. And you're dealing with all these other headwinds, and you can get some actual yield in other places. So somebody might say, well, I can invest in a bond at 6 or 7% rather than wait around for a company that may never turn a profit and hope that they turn a profit, in 10 years from now. And it just doesn't look as attractive because there are other alternatives in terms of yield, and it also just kind of devalues that discounted cash flow methodology. Basically, it's not as valuable to be a growth company. So there's a lot of fundamental headwinds that way. In addition, it just got too darn frothy. It just basically was a scenario where everything was priced for perfection. And in many cases, these companies were trading at crazy expensive multiples, price to sales multiples, where, if your revenue was 1 billion, but you were priced at 100 billion in market cap. Well, think about it from the standpoint of you're not going to make all of your revenue in profit. You have to pay employees, you have to spend, you have to advertise. So usually your profit is only a small percentage. Think about companies that are very profitable. Let's take, I'll just brainstorming. Let's say Target, okay, Walmart, those types of companies. Look, out of 106 billion, there's only 6 billion left in profit. So even when you become a massively profitable corporation, you don't keep the majority of your revenue as profit. You only keep a portion of that because there's so much that goes into running a business, expenses, paying employees, rent, paying interest on your debt, all of these other things. And so that's kind of what, again, gets to the fundamentals. These companies that are borrowing a ton of money with interest rates going up, their expenses go up. So their path to profitability just becomes longer and longer. If you're borrowing $3 billion, well, when interest rates were down in the dumps, it didn't cost you much. Now, all of a sudden, it might cost you a more significant amount, which means it delays your profitability. It creates more headwinds. So they went through, we just had this environment where rates were super, super low for an extended period of time. In fact, internationally, they even went negative. We had negative rates in Germany and other places, which is crazy and a discussion for another time and another class. But with interest rates so low, being a growth stock was kind of that sweet spot. Now that you have to borrow a lot of money and pay higher rates and compete against that, it's just a much bigger headwind. Now, where do we go from here? Is this a screaming buying opportunity? Historically speaking, the things that are crashing the hardest are not likely to be the ones that rebound the hardest. If you go back to, the tech bubble, it was not that most tech stocks recovered. No, not by a long shot. Most of those tech companies went under. And then there were a few select names that recovered over time and went on to bigger and better things. I think the growth sector of the market will experience much the same thing. Think about the global financial crisis when you had financial companies failing. Again, most of them didn't bounce back and recover. You saw Lehman and Bear Stearns and Washington Mutual and a lot of bankruptcies. You saw the ones that were hit the hardest, like the Citigroups, and those have not recovered fully. But the JP Morgans and some of those, Visa, MasterCard that were kind of stayed out of it to a certain extent, they rebounded to bigger and better things. And so I would say the same about the growth complex. Maybe you look at some of the biggest, heaviest hit. Teladoc is down some 80%, 90%. It may not have, I don't think this thing's going back to 300 in the short term. I just don't see that. Will it stay around and be a business? Yeah, but its best days are probably behind it. Whereas there are some companies that are down a lot, but maybe not to the same extent. So here you have, instead of Teladoc, which is from 300 down to 30, 90% or some odd decline. Well, you have something like Snowflake, which is 400 down to 150. Okay, that's 55, 60%, somewhere. It's actually an outperformer. As bad as that looks, it's actually outperformed the majority of those stocks. So do I think that something that has outperformed, that's hung in relatively well, has more potential for a rebound? It has in large part less to work through. See, with something like Teladoc, you have more overhead resistance because you have all this supply. You have so many people that have bought for multiple years at higher prices that as this tries to bounce, it's going to encounter more sellers and more people that want to sell, and it kind of keeps a lid on it. Not that Snowflake is great, but it just has fewer sellers, right? It hit its peak at the end of last year, not back here. It kind of recovered and worked through some of that. I think it's going to be a long road for this stock as well, but I suspect it's far more likely to go on to bigger and better things. So look for something that we always teach at Maverick: relative strength, relative weakness. Yeah, this is an ugly chart, and it's probably going to have lower prices and so on, but it's relatively held up well compared to so many others in the growth complex, and that means that it's at least a candidate that's more likely to see a recovery, and it's more likely that the business has something that separates it from all the rest, right? When you have volatility so extreme like this, that everything gets thrown out, but maybe some of those that are getting held up relatively well tend to be the bigger bounce back candidates. Hope you've enjoyed this class. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.